Hello everybody, in today's video we will be studying the chapter 11 Governance and Social Responsibility in Business of F1 ACCA Business and Technology. Before watching this video, I would request you all to do the previous chapters so that you'll be able to understand this one better, the playlist of which is given in the description box below. So as you all know, every business has a social responsibility and some rules and policies and procedures to follow. That's what we're going to study in this. It is a lengthy chapter, but at the same time it is very easy. Okay, so the first topic is separation of ownership and control. To begin with, what is the difference between control and ownership? Ownership are ownership. So if this is a company and it has some shareholders, so shareholders are the owners of the company because they give the capital required in the business, and the managers or the board of directors who actually work, they undertake the control of the business. But for example, in an entrepreneurship, since the size of the business is small, the owner is only the manager also, right? So in that way there is no difference between the control and ownership. But for larger organizations, it is not feasible for the owners to also be the managers and look after the day-to-day operations, because one person cannot do everything and it's very difficult to handle large organizations like that. So that is what we are studying here. Separation of ownership and control refers to the situation in a company where the people who own the company, the shareholders, are not the same people as those who run the company, the board of directors. This situation tends to occur in larger companies where there may be many external shareholders who play no role in the day-to-day running of the company. The separation can bring benefits to both the parties. So when you separate the ownership and control, then we can have good managers, we can have good directors who are specialized in what they do, right? So specialist managers can often run the business more efficiently than the owners. Managers cannot personally contribute all the capital needed to run the business, so they have to bring in external capital from investors. And the investors do not have any interest in the day-to-day operations of the company. However, there is a risk. Okay, so now we are going to study about one risk by the separation of ownership and problem, and that risk is known as agency problem. So what is agency problem? I'll tell you. So when there are directors running the business and when there are shareholders who are the owners, they are separate. So the directors might not look for the benefit of the business, or they might not look for the benefits of the shareholders. They might look at their own needs, their own requirements, their own goals, and they might do their job with the mindset that they want to fulfill their own needs. So that is an agency problem where the individuals, the directors, the managers, their needs become more important than the organization's goal or the motive. So that is known as the agency problem. There is a risk that the directors may run the business in their own interests rather than those of the shareholders and other stakeholders. This is referred to as the agency problem. Note that smaller companies often do not have this issue, as in these organizations the directors are also likely to own all the shares in the company, meaning that there is no ownership and control, there's no difference. So that's what I've told you about the entrepreneurship organization, right? Illustration. The directors of a large quoted company may hold a board meeting and vote themselves huge salaries, bonus shares, if modest profitability targets are achieved, and contractual terms granting each of them huge compensation payments if they are dismissed. These are in the best interests of the directors, but not in the best interest of the shareholders who own the company, and in those interests the directors are meant to be working. The problem of directors not operating in the company's best interests can be solved by aligning the interests of the directors and the interests of the company. For example, the directors could be paid a small basic salary and bonuses depending on the growth and profits achieved. Directors could be paid partly in shares to make them shareholders. So when you pay the directors and shareholders, technically they also become the owners of the company. So obviously they will not take any bad or wrong decision because they own the company, they own the shares of the company, right? Yeah. So that they have a direct interest in the share price and level of dividends. Adopting such procedures would reduce the agency problem of the directors acting as agents as themselves rather than agents of the shareholders. Now let's do the test your understanding 1. The separation of ownership and control refers to the fact that the owners of a company are always different to the directors of the company. Is it true or false? It is false. Why is it false? Because it's not always, it's only in the large organizations. Now we're coming to corporate governance. So what is corporate governance? So there are some rules and there are some processes and policies which are to be followed by a company, right, for the benefit of everybody. So corporate governance is a set of processes and policies by which a company is directed, administered and controlled. It includes appropriate role of the board of directors and of the auditors of the company. Consider the formal definitions of corporate governance. So, corporate governance is a system by which companies are directed and controlled. And corporate governance involves a set of relationships between a company's management, its board, its shareholders, and other stakeholders. Corporate governance also provides the structure through which the objectives of the company are set and means of attaining those objectives and monitoring performance are determined. The main recommendation of the best practice in effective corporate governance tend to include the following. So these are the things which have to be included in a good corporate like in a good organization. The membership of the board of directors, both executive and non-executive directors, how directors' remuneration is decided and disclosed, the role of the both internal and external audit, how the public as a legitimate stakeholder in a large company has the right to know how the company is being governed. So we need to look after these 4. The first one is the membership of the board of directors, which can include both executive directors and non-executive directors. So what are executive directors? Executive directors are those directors of the company who are involved in the daily day-to-day work. They work in the company every day. They are involved in the day-to-day working operations. What are non-executive directors? Non-executive directors are those directors who do not do the day-to-day working. They check like at times, but they don't come to work in day-to-day operations every day. That's the difference. How the director's remuneration is decided and disclosed. So we need to look on that. The role of both internal and external audit. Audit means checking. We will come to that in the later sections. How the public as a okay. So the public, we need to know about the company's financial systems or the company's, we have to know how the company is being governed, right? We need to know how the company is following the policies and everything. So that's the thing. Non-executive directors. Whilst company law refers to directors in general, there are 2 types of directors which we've done, that is executive directors and non-executive directors. So NEDs are not employees of the company and have no managerial responsibilities, meaning that they do not participate in the day-to-day running of the organization. However, they do attend the board meetings and therefore have a say in the strategic decision making of the company. Do you have any doubts in this? We have just done that, right? So non-executive directors, they attend the board meetings, but they don't intervene in the day-to-day activities of the business organizations. So what are the roles of NEDs? NEDs have several key roles in the organization. So according to the Higgs report, these are some of the roles of the NEDs. So what are their roles? The first thing is strategy. So non-executive directors, even though they don't help or work in the day-to-day operations, one of their duty is strategy. They need to work on the strategy of the business. The NED should constructively challenge and contribute to the development of the strategy. And then we have performance. So NED should also look after the performance of how the executive directors are working. They need to see how the working is going on, and they need to see how the business organization has performed, and then they need to give their advice, and they have to monitor the senior management. Risk. NEDs should satisfy themselves that financial information is accurate and that financial controls and systems of risk management are robust and defensible. So, NEDs must also check that the risk management is done well in the organization. And then we have people. NEDs are responsible for determining appropriate levels of remuneration for executives and have a prime role in appointing where necessary, removing senior management, and in succession planning. So people. So when executive directors must be given some remuneration. So for that the non-executive directors decide it. Also, where you need to, there are some people in the senior management you might want to hire or you might want to remove. All that is also taken care by the non-executive directors. So what are the four roles? First thing is strategy, second is performance, then we have risk, and then we have people. Independence. So NEDs should be independent as far as possible. So what do they mean by independence? Independence means that the NED is not related to somebody in the company. So if there is somebody who is not related to anyone in the company, then they will be unbiased and they will do the work with an unbiased manner. If me and my friend start a business and if my friend was the director, she will do things in my favor. If I want to do something wrong, then she will also do something wrong with me, right? So that is the reason why we need. But if I have a business organization with someone who is not my friend, will they support me when I'm doing wrong things? No. So that's the reason why we need NEDs to be independent. So in order to ensure that their oversight role can be carried out as effectively and responsibly as possible, this is similar to auditor independence, which is discussed in the later chapter. NEDs must not. So these are some of the rules which need to be followed, which NEDs have to follow. If someone wants to be the NED of a company, they should not have been an employee of the company in the last 5 years. So in the last 5 years, I should not be working in the company if I want to be the NED. We should not have had a material business interest in the company for the last 3 years. So what is material business interest? Like if I'm a supplier for them, if I'm providing them goods, if I'm providing them raw materials, if I'm providing them services, then I cannot be the NED because I had some kind of relationship with them. The next one is participate in company share options or pension schemes. So I cannot participate in the company share options or company's pension schemes. Why? Because if I am doing that, then I will see everything in my benefit. All the decisions I'll take, I'll keep in mind my pensions, I'll keep in mind my share options, and I'll do something which will benefit me, which is unfair. Have close ties with company directors or senior employees. The friend part I was explaining in the beginning, it's the same thing. Serve as a NED for more than 9 years with the same company. So if I become the NED of a company, the maximum tenure is 9 years. I cannot be their NED for more than 9 years. If any of these apply to NED, their independence will be seriously compromised. Other recommendations. At least half of the board should be independent NEDs. So it is a requirement that at least half of the board must have independent directors, non-executive directors, excluding the chairman, who is also often an NED. A small company should have at least 2 independent NEDs. So what did we see? That at least half of the board must have independent NEDs. In case if it's a smaller company, then 2 of them should be independent NED. One of the independent NED should be appointed to be the senior independent director. So we have many senior independent directors. So one of the senior independent director must be there, who is an independent NED. They are available to be contacted by the shareholders who wish to raise matters outside the normal executive channels of communication. It is also worth noting that good corporate governance recommends that the role of chairman, who is responsible for the activities of the board, such as appointing senior management and strategy development, should be distinct from the CEO, who is responsible for the day-to-day operations. So, CEO is responsible for the day-to-day operations, whereas the chairman is responsible for the actions of the board of directors. If one person holds both the roles, it will be given them too much power and it will allow them to individually dominate the running of the company. Executive directors and NEDs would typically be required to stand for re-elections by shareholders every 3 years. So every 3 years, the executive director and the non-executive director are expected to stand for re-elections. NEDs who have been with the company for over 9 years must stand for a re-election on an annual basis. Test your understanding too. Now read it yourself and do it yourself. It is very easy. So as we have read the above, so I'll tell you where you can refer the answer to. It's very easy. So this 5 points which we've seen, these are the reasons why Esther cannot be the NED. I'm sure you can do it yourself. I've even given you the answer. Now we come to the Remuneration Committee. So what is a Remuneration Committee? A remuneration is the payment of the salary or a mode of pay which we have to pay to the directors, executive directors basically. So a Remuneration Committee is a committee made up of non-executive directors which is responsible for deciding on the pay and incentives offered to the executive directors. It is an important principle of corporate governance that no director should be involved in setting the level of their own remuneration. So, executive director cannot themselves decide their pay or incentive. The board of a listed company should therefore establish a remuneration committee of at least 3 independent entities. So, in a board of a remuneration committee, there should be at least 3 independent NED. In case the company is small, they need 2 independent NED. The remuneration committee is responsible for setting the remuneration of all the executive directors, including pension rights and any compensation payments. The whole board of directors should be responsible for deciding the level of remuneration for NEDs, although the decision might be delegated to a committee of the board. Now let's see what are the advantages and what are the disadvantages of a remuneration committee. So the first advantage is it avoids the agency problem. So we saw in the previous part of the chapter what is an agency problem. So agency problem is when the directors think of their own advantages and their own benefits. So agency problem is avoided in this situation because the non-executive directors are deciding the pay. So when there is a remuneration committee, it leaves the board free to make strategic decisions about the company's future. So some time is saved and some work load is saved for the board of directors. They can focus on other things. The disadvantages. So there can be a situation like the executive directors can tell the non-executive directors that if you give us this much pay, then we will also vote that you get this much pay, or some kind of fraud like that. So that might happen. A situation you scratch my back, that's what I've explained. And then there will be a cost involved in preparing and holding committee meetings, obviously. Test your understanding. Which of the following can non-executive directors accept as a remuneration from the company? What is the answer? Obviously, the non-executive directors will want a fixed daily rate for their time. The time they've given, they need to be paid for that. Now we come to the Audit Committee. An Audit Committee consists of independent NEDs who are responsible for monitoring and reviewing the company's internal financial controls and the integrity of the financial statements. So Audit Committee basically audits the reports or checks the reports. So Audit Committee mainly consists of NEDs only, non-executive directors. The Audit Committee acts as an interface between the full board of directors and both the internal and the So there's a full board of directors, internal auditors and external auditors, so it acts as an interface between the same. What are the responsibilities of the audit committees? So the audit committee include these responsibilities: reviewing the accounting policies and financial statements as a whole to ensure that they are appropriate and balanced. So they review the statements and they check if they are balanced or if they are appropriate or if they are right. The second thing is it reviews systems of internal controls and risk management. So the audit committee also checks the internal management systems and procedures and also the risk management. However, there can be a separate committee for the risk management. And then we have agreement of the work agenda for the internal audit department as well as reviewing the results of the internal audit work. So the audit committee also ensures like what is the work of the internal audit and it checks the results or the reports, making recommendations to the board for them to put to the shareholders relating to appointment and removal of external auditors as well as the remuneration and terms of engagement. So it can make audit committee makes recommendations to the board to for them to put to the shareholders relating to if they want to appoint some new external auditors as well as the remuneration and terms of engagement. Liaising with external auditors, in particular relating to review and monitoring the external auditors' independence. So, what are the main advantages of an audit committee? So, the main advantages of an audit committee are that it allows the auditors to report their findings to independent directors only. So, this avoids a number of problems. What? First thing, the external auditors do not have to report frauds or errors to the executive directors who may be responsible for perpetuating them. The second thing is internal auditors are unlikely to feel comfortable reporting to the executive directors because they are the ones who are actually working. So it's also going to be beneficial for them because they just have to report to the NEDs. Nomination committee. A nomination committee is formed in order to ensure that the composition of the board is balanced. So why is the nomination committee formed? It ensures balance in the board. So it monitors the process for appointment of directors to the board of directors as well as making recommendations for appointments to the board. Typically, when recommending appointments, the nominations committee need to consider the size of the board. So they have to check the various skills which are needed to be present on the board, the mix of executive and non-executive directors, whether they are present in the correct numbers, whether the composition is right, the need for the continuity in the board. They need to attract directors from various backgrounds to improve the organization strategy. So why do we need a nomination committee? For maintaining the composition and the balance in the board. Public oversight. So what is public oversight? Giving you a minute, just read it. It's very easy. As mentioned earlier, the public is a legitimate stakeholder in a large company. So public is one of the most important stakeholder. The public deserves to know about the organization. So the most obvious means of public oversight of corporate governance is via the publication by companies of their annual report and financial statements. So the organization owes to the public to show them their financial statements in the annual report because they deserve to know. These will disclose a number of important matters such as the role and actions of the audit and remuneration committees during the year, as well as the composition of the board. While companies are required by law to send a copy of this information to every shareholder, most companies will also post a copy on their websites or will provide a paper-based copy to any member of the public who is willing to know about it. Most companies are required to submit their annual financial statements to a regulatory body, Companies House in the UK, we know that, so that interested parties can review them. Some countries or industries have set up public oversight boards. So what is a public oversight board? These organizations monitor whether the organization are complying with the relevant rules and regulations and the Public Oversight Board can also take action against those that fail to meet the required standards. Illustration: JJB Sports Independent NEDs. Among the independent NEDs at former sportswear company was Matthew Pinsent, an Olympic gold medal winning rower. He was well known to the public and had a good reputation, so the public saw him as representing the views of wider society. Pinsent may have had little or no experience of big business, but the public would not necessarily have seen this as a disadvantage in representing them on the board. So, what are the benefits of corporate governance in an organization? So, these are very easy. So, what are the benefits of corporate governance? Corporate governance is complex, corporate governance is also really expensive, and it will increase the costs, but still the organizations follow it. What are the reasons behind it? Is it really worth it? Is it worth the time? Is it worth the complexity? Is it worth the price? Yeah. So it is interlinked with the level of business success. So improved controls, and when they follow the corporate governance, when the improved controls in the decision making will aid the corporate success as well as growth in the revenues and profits. Investor confidence. As an investor, when they know that a company is following the laws, is following the corporate governance, is following the rules and regulations, they will feel happier and more safe to invest in that company. Minimization of wastage. So by following the corporate governance, we can minimize the wastage of the resources by having a proper scheme of planning, right? Strong corporate governance should help minimize wastage within the organization, as well as corruption, risks, and mismanagement. Listing requirements. So, following the corporate governance guidelines is required by many stock exchanges, such as the London Stock Exchange, in order to obtain a listing. So, what are the 4 advantages? Business success, investor confidence, minimization of wastage, and listing requirements. Corporate social responsibility. So, what is CSR? CSR refers to the idea that the company should be sensitive to the needs and wants of all its stakeholders rather than just the shareholders. If I have a company, I can't just think only about the shareholders while taking the decision. I need to consider all the stakeholders, the public, the government, the employees, the employers, the everybody. It refers to an organization's obligation to maximize its positive impact while minimizing the negative effect. Note that CSR, corporate social responsibility, is linked to sustainable development, which suggests that organizations should use resources in such a way that they do not compromise on the needs of the future generations. As mentioned above, CSR involves being sensitive to the needs of an organization's stakeholder. This means that in order to improve its CSR position, an organization must first understand who its stakeholders are and what they expect. What is a corporate social responsibility? Okay, so we are going to see the formal definition of CSR. It has been proposed by the WBCSD, World Business Council for Sustainable Development. What is sustainable development? It is meeting the needs of the present generation without compromising on the future generation. CSR is the continuing commitment by business to behave ethically and contribute to economic development while improving the quality of life of the workforce and their families as well as of the local community at society at large. The WBCSD, what was WBCSD again? The World Business Council for Sustainable Development. The World Business Council of Sustainable Development, CCSR, fitting into overall corporate responsibility as follows: corporate financial responsibility, corporate environmental responsibility, corporate social responsibility. We need to look at the money we have, we need to take care of the environment around us, and the social responsibility must also have to be fulfilled. However, the distinctions between each category can be blurred. Key issues in the CSR debate include employee rights, the laws that prohibit ageism and other discrimination at work. We cannot discriminate based on various factors in the market. Environment protection, reducing the factory emissions of poisons and pollutions. We need to have good relations with the suppliers, and we need to involve the community in the decisions we take or in anything major. Okay, this is a case study about the clothing brand Marks and Spencer. So, what does the Marks and Spencer do? How does it fulfill its CSR, corporate social responsibility? So, its products are throughout the three stages of its product's life. The aim is to encourage ethically and environmentally responsible behavior. So, they recycle their goods. People. Everyone who works at Marks and Spencer is entitled to a mix of benefits. This approach is also encouraged amongst companies, suppliers, franchisees, and other business partners. Places. The company recognizes its obligations to communities in which it trades. Successful retailing requires economically healthy and sustainable communities. Now we have the stakeholder needs analysis. So, what is the stakeholder needs analysis? It is finding out who our key stakeholders are and researching about what their needs are. Typical stakeholders, internal, external, and connected, and their needs have already been identified in the earlier chapter. However, a typical list is not what should be created here. Each company must sit down with a blank sheet of paper and identify the shareholders for them. It differs for every business. Once the organization has identified its stakeholders, it needs to understand what their needs and wants are. There is no better way of accomplishing this rather than asking them directly. So, what are the possible ways? We can prepare questionnaires, we can have some focus groups, we can have some direct interviews or interviews with the representation to know what their needs are. Car manufacturers. As well as being sensitive to the requirements of a customer with respect to factors such as price and performance, we should also look at the public attitude towards the pollution. We need to see the government policies on road tax and fuel tax. As a result, it may choose to develop more environmentally friendly vehicles. Because right now we need larger cars, but later on I would personally not buy a car if I know that it is polluting the environment, right? So we need to look at those factors. Test your understanding 4. A supermarket buys its goods on credits and sells them for cash. Therefore, it has a strong cash flows all the times. What are the business needs of a supplier to such a supermarket and its relationship with the supermarket? A long-term business relationship so the supplier can plan for the future. A large value of goods sold on a regular basis. Agreed quality standards that both parties can work with. Fair prices and prompt payments on the agreed dates. To some stakeholders, the company owes obligation arising from the law. For example, we need to pay employees their salary every month. If an employee is made redundant, there is some redundant pay. Other obligations arise voluntarily due to the company's commitment to CSR, to discuss their plans with interested pressure groups before a particular plan is adopted. Illustration 5. This is a very easy case study. It is an illustration. Just read it yourself. Pause the video and read it yourself. If you have any doubts, then drop it in the comments below. The importance of CSR. So, what is the importance of CSR? Traditionally, adopting a CSR approach has been seen as having a number of drawbacks. So, what are the drawbacks of having corporate social responsibility? The first thing is that increased cost. So, if we want to see more sustainable ways, more environmental friendly ways, it is obviously going to cost us more. So, there is increased cost of sourcing materials from ethical sources, and then we need to turn away our businesses from customers who are unethical, right? The management time can be taken up by CSR planning and implementation. The management will have to focus on this, so a time is taken from there. However, more recently, businesses have been started to see a key benefits So what are the benefits? Good CSR can attract the customers by enhancing the organization's reputation, like Marks and Spencer we have seen. An ethical approach to business will help to attract and retain good quality employees. Avoiding pollution will save the money in the long term. Many governments are now fining for increasing the taxes for more polluting businesses. Being environmental friendly can save money. For example, being energy efficient will not just benefit the environment, it will also lower the organization's utilities bill. Illustration. So this is an where did it go? So this is a case study. This is a case study on the importance of CSR to an organization. The organization we have is a public limited company, BAA PLC. So BAA owns and operates 7 airports in the UK. BAA recognizes that they are responsible both directly and indirectly for a variety of environmental, social and economic impacts from their operations. So what are the positive impacts of the BAA PLC, who has 7 airports? So it is employing 12,000 people, it is providing them with jobs, it is allowing people to travel to meetings, and it is allowing people to be connected, and it is supporting the global economy, and it is allowing tourists to visit and enhance our culture. But what are the negative impacts? So there's a large number, like a large consumption of fossil fuels, and there are emissions of greenhouse gases, and the people living nearby the airport have often faced the issue of noise pollution. So BAA sees its CSR program as managing these operational impacts in order to earn the trust of their stakeholders. So what are the solutions in such a situation? What should BAA PLC do? So for example, local people living near airports are sensitive to the noise of aircraft approaching and taking off. If BAA did nothing about this issue, local people could complain to politicians, who could pass laws to curb the number of flights which would like kind of damage the company. So as part of its CSR approach, BAA will therefore offer to buy the properties of the people living near the airport at a very high price, so that it owns the property, so there'll be no issue like this anymore. You should consider, and also it will offer to pay for the soundproofing for the properties. You should consider whether such expenditure is an expense against the company's profits or an investment in building up a strategic asset of goodwill among the local community. Test your understanding 5. Which of the following benefits could be realized from a successful CSR program? So what are the benefits? Improvement in innovation by identifying new market opportunity? No, we haven't read anything like that. Improvement in the company's reputation? Yes. Improvement in relationships with internal and external stakeholders? Yes. Maintenance of strategic assets such as licenses to operate? That also. So the answer will be 1, 2 and 3 according to me. So that would be A. So, but that is not the answer. Why? Because the answer, wait. I said that improvement in the company's reputation is the answer. Improvement in relationship and maintenance of static. Okay, this is 1, this is 2, this is 3 and this is 4. It's not mentioned. Our answers were 2, 3 and 4. So which one is that? B is the 2, 3 and 4. Okay. Now let's come to committees. What is a committee? A committee is basically a group of people who are appointed to administer, discuss and make results concerning a subject. Typically, committees tend to be permanent or at least long term. They have authority and they follow well established procedures. They provide a way of making difficult decisions by involving key individuals and departments. What are the purpose of committees? Let's see. So a committee has various purpose, various responsibilities. So the committee can brainstorm new ideas for the organization. They allow a number of people with different skills and knowledge to work in a coordinated manner. They also act as a delayed mechanism. So because so much time is taken up when you have a committee, so they act as a delaying mechanism. And how is it a positive thing? so that the decisions will be taken carefully and not hasty and in a rough or a hurry manner. And then we have, they can make or implement decisions within the organizations. They can oversee a function and procedure. For example, public oversight boards, they can gather information about a particular issue. What are the types of committees which are used by business organizations? So we saw what an executive committee is. It is a committee with administrative powers which meets frequently, like we saw one of the committee was executive directors. And then we have board of directors. Standing committee. So what is a standing committee? A standing committee are formed for a particular purpose on a permanent basis. So what is an ad hoc committee? We've seen in one of the chapters the word ad hoc. What does that mean? For a particular task, or for a particular project. So ad hoc committee are formed to complete a particular task and have a limited durations. What is a subcommittee? What do you understand by the word sub? Subhead, right? So they work under a head. This is simply a subordinate committee comprised of member appointed by a parent committee. This could look at a particular issue or a way of helping the parent committee to deal with its workload. So read this illustration 7. We have done this a million times by now. Pause the video and read it. HPLC appointed 5 members of staff to a new committee. This committee's purpose is to investigate a on-off failure in H's production processes that led to the loss of $100,000 worth of products, and it is to make recommendations as to how H can avoid similar problems. So what is the task of the committee here? To solve a given particular task. So it's going to be ad hoc. Advantages and disadvantages of committee. So what are the advantages? Committees bring together individuals with necessary skills. Committees tend to slow the decision making process so we can take more informed decisions. Decisions are likely to be more easily accepted by the organization as they have made a committee with representatives of all the departments. Setting up committee can delay the decision making process, so it buys the company time. More people are involved in the decision making process, leading to motivation increasing. Collective responsibility means that no individual is held accountable, so the whole committee is held accountable. What are the disadvantages? Committees tend to be slow at making decisions. This could not only make the organization miss out on valuable opportunities, but it also increases the costs of the decision making process. Collective responsibility means that no individual is held responsible or accountable for the poor performance, reducing the motivation of the committee. Members of committee may wish to further the objectives of their own departments. This can lead to conflict. Committees tend to work based on compromise between various members because obviously this may mean that they fail to recommend decisive action because all the people, there might be conflicting opinions. Committee members normally attend committee part-time. The rest of the time they just focus on their workload. Some experienced committee members may dominate. The key roles in the committee. So there are likely to be 2 key roles for the proper functioning of any committee. The first one is the chairperson. The chairperson must have sound knowledge of the relevant regulation and awareness of non-verbal behavior, skill of summarizing, skill in communicating, the ability to be decisive, the ability to silence people in a firm and friendly manner. So the chair is a crucial role that involves guiding the proceedings of the committee. So what are the responsibilities of the chair? The first thing is keeping the meeting on schedule and agenda. He or she must ensure all the relevant issues are discussed. Then maintaining the order, impartiality, summing up, checking and signing the minutes of the meeting. So what are the responsibility of a chair in a committee? It is scheduling and it is keeping the meeting on schedule and the agenda, maintaining order, dealing with impartiality, summing up and checking and signing the minutes of the meeting. What is a secretary? Who is a secretary? The individual undertakes all the administration relating to the committee and supports the chair. So the secretary supports the chair and it in order to have a smooth functioning in the committee. What are the responsibilities to the committee meeting? So the responsibility of the secretary are fixing a date and time of the meeting, booking the venue, preparing and issuing the agenda and other relevant documents, assisting the chairperson, making notes, advising the chairperson on points of procedure, preparing minutes, acting on and communicating decisions, dealing with correspondence. That's it, we are done with the chapter. Let's just move to practice questions. Consider the following two statements. The separation of ownership and control is only relevant in the context of limited companies. That's not true. Corporate social responsibility is concerned with the company's obligations to just its external stakeholders. That's also not true. So the answer, which is correct, neither of them are correct. Which of the following would reduce the agency problem in a large quoted company? So we saw that the directors must be given shares so that they feel like they take good decisions because their shares are also involved. So the option of is B. What proportion of the board members in the UK listed company should be made up of independent NEDs? So we saw that half must be made, right? I hope you remember all this. Maria has been asked to act as a NED. Which of the following facts about her would prevent her from taking this role? She owns 20% of the share capital. This affects. She is to be paid as a fee. That doesn't matter. Up until last month, she was the executive director. Even that matters. So 1 and 3 matters. So the option is B. Right? Am I right? Is the option B? Yes. What is the primary role of a public oversight board? Read all the options. The correct option is C. Monitoring corporate compliance with key rules and regulations. Which of the following is not a major purpose of committees? Okay. What did we see? That committee buys time for the company and it acts as a delaying mechanism. So speeding up was never its major purpose. Which of the following is an advantage of using a committee rather than an individual to make a decision? So everybody will agree to this as well. Here are a number of statements relating to NEDs. They must not participate in the company share option. Okay, write down 4 options A to H given in the list which are correct to the NED. So they must not participate. Here A is correct. They must participate. Not true. They should serve on the board of the same company for more than 7 years. They should not. No, it was 9 years. They may not challenge executive strategies as executive are not directly voted. They should just form over half of the Remuneration Committee. That's also not there. They should take major role in appointing and these 3 are correct. Pause the video and do it yourself. If you have any doubt, you can ask me. So AFGH is the answer of test to understanding 14. In the next one, we need to do the disadvantages of CSR. CSR increased material costs, increased scrutiny, management time is taken up, and having to turn away business. ACDF. I hope it's clear. I hope this chapter was clear for you all. Stay tuned for the further videos. We'll be completing the rest of the chapters and we'll also be doing the test kits. The playlist of everything is given in the description box below. Thank you.